Hi, my name is Easton Lewis, and today I'll be going over Chapter 23, which is the rules governing the insurance and trading securities. At the beginning of the chapter, Securities and Exchange Commerce is described, which is also known as the SEC. This is a federal administrative agency charged with the overall responsibility of regulating securities, ensuring that investors receive full or fair disclosure of all the material facts with regard to any public offering of securities, and has wide enforcement powers to protect investors against manipulation, insider trading, and other dishonest dealings. St. Patrick's Day bailout of an investment banking firm by the U.S. taxpayers also discussed. And this is Bears Stearns and Corporations was heading for insolvency and planned to file bankruptcy. The federal regulation urged to sell the firm to J.P. Morgan at a price of $2 a share or $23 million, and a stock swap transaction for 39.9% of Bear. Federal Reserve agreed to fund up to $30 billion of Bear's non-liquid assets. There were varied responses to the bailout from the stakeholders. The Sarah Barnes-Oakley Act of 2002 was also described in the chapter, and this is a corporate accountability which requires CEOs and CFOs to certify financial reports. Profits and bonuses must be forfeited, and earnings that are restated due to the security fraud. And the new accounting regulations was established to the Public Company Accounting Oversight Board and prohibits auditors from offering 9 specific types of consulting services to their corporate clients. The criminal penalties that go along in this Sarah Barnes-Oakley Act of 2002 include 25 years of imprisonment for fraud, 20 years imprisonment for destruction, alteration, or fabrication of records. CEOs and CFOs who knowingly certify a report that does not comply with requirements, which is up to 5 years imprisonment and $1 million fine, and willful certification of non-complying report by officers, which is $5 million in fines or 20 years in prison, or possibly both. And lastly is the 20 years imprisonment for mail and wire fraud. This is up to 10 years imprisonment for defrauding pensions funds. Security is also described in the chapter, and this is a stock, bond, or any other installment of interest. And this represents an investment in a common enterprise with reasonable expectations of profits derived solely from the efforts of those other than the investor. The characteristics include common enterprise, reasonable expectations of profits derived solely from the other's efforts. Registration of securities under the Security Act of 1933 is also described, and this is the purpose is the full disclosure, which helps investors make informed stock purchase decisions. The registration statement process includes prosecutions, and Part 2 information statements are to be filed with the SEC before selling any security to the public. The disclosure requirements to identify issues is a non-reporting issuer, which is not required to file reports under the 1934 Act. The unseasoned issuer, which is one who has reported continuously for at least 3 years. The seasoned issuer, who is one who has filed continuously for at least 1 year and has a minimum market value publicly held of stock of $75 million. And a well-known seasoned issuer, which is one who has filed continuously for at least 1 year. The security registration process is also described in the chapter, and this is the 2005 revisions brought flexibility to rules regulating regarding written communication by issuers before and during registration of securities. Shelf registration is also described in the chapter, which is procedures whereby a large corporation can file a registration statement for securities it wishes to sell over a period of time rather than immediately. Liability remedies and defense under the 1933 Securities Act is introduced as well, and this is a misrepresentation in the registration statement. Affirmative defenses available to defendants include the plaintiff knew on the omission or untruth A decline in value of the security resulted from causes other than misstatement, and the statement was prepared with the due diligence expected of each defendant. The failure to file a registration statement is also consist of it. Next is misrepresentation or fraud in the sale of security. And then lastly, for liability remedies and defenses under the 1933 Security Act, is the governmental remedies, and these include the administrative action, the injunction action, and the criminal penalties. Next is the Securities Exchange Act of 1934, and this is the registration of securities issuers was extended to all corporations that have assets of more than $10 million, have a class equity securities with 500 shareholders, and are involved in the interstate commerce. Brokers and dealers are required to register with the SEC under the Exchange Act unless exemption. Disclosure of compensation is also described, and this is the issuer is expected to disclose executives' compositions over the last 3 years. Security markets include the exchange market, the over-the-counter OTC market, and they're regulated by the SEC with the help of National Associates of Security Dealers, known as the NASD, and the stock exchanges. The solution of proximity is Section 14, which makes it unlawful for any company to solicit proxies in the conservation of the rules and regulations of the SEC. The shareholder proposals is the management needs to be notified in a timely manner before a shareholder meeting or a special meeting. The proxy contest is also occurs when a group of shareholders wants to elect its own set of candidates to the board. And then next is the tender offer, which is a public offer in the individual corporation made directly to the shareholders of another corporation in an effort to acquire the targeted corporation at a specific price. The rules governing tender offers are found in sections 13 and 14. And the next is the remedies and defense strategy. The remedies section 14E makes it criminal offense to make it untrue and misleading statements, engage in fraudulent acts or deceptive practices, and the defense strategies is allowed if the managers of the targeted companies act in good faith in the best interests of shareholders and do not waste the corporate assets. They also cannot enter into conflict of interest situations. The liability and remedies under the 1934 Exchange Act include the criminal penalties, which is individuals and partnerships of corporations, the SEC action, and private actions. The short swing profits is also described in the chapter, and this is profits made from directors, officers, or owners of 10% or more of the securities of a corporation as a result of buying and selling the securities within a 6-month period. It is presumed to be the basis of the insider information, and the liability is cases are filed on the insider with the intent to recover profits from them. State security laws are known as blue sky laws, and these are regulated purchases and sales of securities in interstate commerce. It's similar to federal laws and the Uniform Securities Act, which is implied to bring conformity to state security laws. And lastly is the National Security Market Improvement Act, and these are limits and regulation of investments accompanying to the SEC. Next is the e-commerce online securities disclosure and fraud regulation. And this is a marketplace of securities where the internet efficiently accelerates trade, and investigators of the company can take advantage of the DGAR database. And then fraud in the marketplace is also known to pump and dump problem of stock prices. And then lastly for the chapter is the global dimensions of rules governing the insurance and trading of securities. And this is legislation prohibiting bribery and money laundering overseas. It's legislation governing foreign securities sold in the United States and regulations and offshore transactions.